Today, Evergrande, fragile. Handle with care. The market update for the 18th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. In today's show, we look at the latest market data and focus in on the big questions around China Evergrande Group, as opinion is divided between those who think this could be a replay of Lehman Bros leading to a broader financial crisis, and those who think the CCP will ultimately save the day. It seems the international markets aren't so worried, at least for now. But I'd remind you, September and October are witching months for financial crashes, and there is plenty of reason to think this might be true in 2021 as well. In the meantime, the Fed has its own problems, as it came to light that two Federal Reserve Bank presidents had engaged in controversial stock trades. But first, in the US, the S&P 500 fell on Friday, extending its weekly losses for the second straight week as weaknesses in material stocks and tech stocks added to investor caution ahead of the Federal Reserve's meeting next week. The S&P 500 fell 0.9%, the Dow Jones lost 0.5%, and the Nasdaq slumped 0.9%. Material stocks continue to add to losses from earlier this week, with mining stocks adding pressure following an ongoing rout in commodities, including iron ore. And then, of course, there's the troublesome property sector in China. And a fall in mega-cap tech stocks also weighed on the broader market, paced by a decline in Treasury yields. Alphabet, Apple, Facebook, Amazon and Microsoft were all in the red. And the US 10-year Treasury climbed to a more than 1 week high, underpinned by positive economic data and expectations the Federal Reserve is set to offer further clues on plans to tighten monetary policy at next week's meeting. The University of Michigan's preliminary consumer sentiment index rose to a reading of 71 in September after falling to 70.3 in August. We expect the FOMC to open the door to a plausible November taper announcement, conditional on a solid September employment gain, said one analyst. Of course, the Fed meets next week. With the broader market on course for a second weekly loss, some on Wall Street, though, continue to expect further pressure. Investor sentiment is getting more bearish after the shallow declines of early September. We remain on guard for further volatility ahead as we make our way through the September and October window. Watch 4,400 plus for initial support on the S&P, said Janie Montgomery Scott in the note, partly because there was an unexpected rise in monthly retail sales. So that reheated debate on expectations for the Federal Reserve to tighten monetary policy ahead of the US Central Bank's meeting next week. The Commerce Department said on Thursday that retail sales rose 0.7% last month. That confounded economists' forecasts of a 0.8% decline. The Retail Sales Control Group, which is a larger impact on US GDP, climbed 2.5%, topping expectations for a 0.1% decrease. The upside surprise in retail sales suggests that the new wave of the pandemic is just not having a major impact on the economy. This could further assure Federal Reserve officials. The Fed gets its two-day meeting underway next week, with many on Wall Street expecting the central bank to lay more plans ahead with regard to monetary policy tightening. Retail sales rebounded in August despite sizable drags from auto sales. Outside of autos, sales posted broad-based increases with particular strength in online sales, general merchandise and furniture sales. The US Department of Labor reported initial jobless claims increased by 20,000 to 332,000 in the week ended the 11th of September. That's missing forecasts, which was for an 18,000 decline. On the manufacturing front, the Philadelphia Fed reported that its manufacturing index rose to a reading of 30.7 from 19.4 in August. The positive economic data failed to spur cyclical corners of the market, as energy and materials were the worst performing sectors on the day. Energy, meanwhile, gave back some of its recent gains, even as oil prices cut their losses. In a blow to vaccine stocks, a Food and Drug Administration advisory committee voted 16-2 against the Pfizer-BioNTech booster shot for the general public, citing the need for more data. The panel did vote in favour of an emergency use authorisation booster shot for people aged 65 and older and high-risk persons. But the final decision will be made by the FDA, though the health watchdog tends to follow the advice of its committee. The volatility index was up 11.34% to 2081. Gold futures was down 0.24% to 1,752. And crude oil for delivery in October fell 0.88% to 71.92, while the euro-US dollar was down 0.31% to 1.1728, and the US dollar index futures was up 0.32% to 93.21. And amid the copious data releases, there is one read that stands out. In contrast to the big macro indicators of employment, consumer spending, and industrial production, the recovery in consumer income has been abnormally weak in comparison with economic recoveries following the end of the recessions since 1970. This cycle is different, with a sudden dramatic collapse in the economy in the spring of 2020 thanks to the pandemic, followed by an equally remarkable government-supported recovery overall. Yet the recovery in household income has been notably soft compared to recoveries over the past 50 years. Since the current expansion began in May 2020, US personal income has varied sharply but remains effectively flat through to July 2021. Since the expansion started, that's over a year ago. By comparison, recoveries in income in decades past at equivalent points in the expansions have been sharply stronger. Which begs the question, is this a temporary phenomenon, or is there something more long-lasting going on here? Certainly, if personal income's rebound remains unusually weak, as it has been so far, there will be some significant cost for the US economy, perhaps in the form of softer than expected gains in consumer spending and confidence in the months and years ahead. The August report on personal income is scheduled for October the 1st, so that will be one to watch. And of course, income growth in Australia has been and will remain anemic for some long time. And so now to the thorny issue of the China Evergrande Group. Evergrande is currently the world's most indebted real estate developer. The central question, though, is whether Chinese authorities plan to allow Evergrande's creditors to suffer major losses, or whether the country's communist government, which prizes stability and control, will intervene in some way to avoid a messy default and the damaging ripple effects that it could trigger. And China injected more cash into its banking system. As a sign, authorities are seeking to avert a funding squeeze amid a seasonal rise in financing demand and the intensifying debt crisis at China Evergrande. The People's Bank of China added 90 billion yuan, equivalent to $14 billion, of funds on a net basis through 7-day and 14-day reverse repo agreements on Friday. That's the most since February. That was the first time this month it added more than 10 billion yuan short-term liquidity into the banking system on a single day. The move comes as the trouble facing China Evergrande Group fuels investor concerns over the health of real estate and credit markets. Adding to the stress is a seasonal spike in demand for cash as banks hesitant to lend towards the end of the quarter ahead of regulatory checks. Liquidity also tends to diminish at this time of year ahead of a one-week holiday at the start of October. Avoiding a systemic liquidity squeeze is the absolute priority for the PBOC, and it means to do so, Societe Generale SA economist led by Wei Yao wrote in a research note, a Lehman-style financial market meltdown is not a top concern, but an extended and severe economic slowdown seems more probable. Evergrande Group is saddled with more than $300 billion in total liabilities. That's equivalent to about 2% of China's GDP, and is in the throes of a liquidity crisis that has sent it scrambling to raise funds to pay its many lenders and suppliers. Financial markets have priced in likely default on its bond payments, and expectations are high that its assets will have to be restructured. In order to ensure fair information disclosure and to protect the interests of investors, after the company's application, all existing corporate bonds of Evergrande Real Estate was suspended for one day following the opening of the market on the 16th of September. Now, that's interesting because that really is a sign of distress. Since the market resumed trading, those bond trading methods will be adjusted, they said, from the date of resumption, and that includes a whole bunch of different bonds. Now, of course, by definition, bonds are meant to be relatively safe and secure, but of course they can turn to junk quite quickly, especially if the company isn't able to service the coupons on those bonds. So the fact that it's been suspended is significant in its own right. Of course, the question is, how significant is it really? Now, there are a number of constituencies impacted by Evergrande, from individuals in China expecting to receive a completed home, through to the 120 or so global and local banks who hold the bonds, plus the broader cadre of shareholders who are watching value ebb away. Recently, protests have intensified at China Evergrande Group offices across the country as the developers fall further behind on promises to more than 70,000 investors. The construction of unfinished properties with enough floor space to cover 3/4 of Manhattan grinds to a halt, leaving more than 1 million home buyers in limbo. And there were fire sales which pummeled an already shaky real estate market and squeezed other developers and rippled through a supply chain that accounts for more than 1/4 of Chinese economic output. COVID-weary consumers pulled back even further, and the risk of popular discontent rose during a politically sensitive transition period for President Xi Jinping. Credit market spreads were stressed, from lower-rated property companies to stronger peers and banks, and global investors who bought something like $527 billion of Chinese stocks and bonds in the 15 months through to June looked to try to sell. While it's impossible to know for sure what will happen if Beijing allows Evergrande downward spiral to continue unabated, China watchers are gaming out worst-case scenarios as they contemplate how much pain the CCP is willing to tolerate. Pressure to intervene is growing as signs of financial contagion increases. As a systemically important developer, an Evergrande bankruptcy would cause problems for the entire property sector, said Shen Meng, director of Chancellor & Co., a Beijing-based boutique investment bank. Debt recovery efforts by creditors would lead to fire sales of assets and hit house prices. Profit margins across the supply chain will be squeezed and also lead to panic selling in capital markets. For now, Shen, and in fact nearly all of the other bankers, analysts and investors, say that Beijing is in no mood for a Lehman moment. Rather than allowing a chaotic collapse into bankruptcy, they predict regulators will engineer a restructuring of that $300 billion pile of liabilities that keeps systemic risk to a minimum. Markets seem to agree. The Shanghai Composite Index is less than 3% off its 6-year high, and the yuan is trading near the strongest level in 3 months against the dollar. And yet, a benign outcome is far from assured. Beijing's bungled stock market rescue back in 2015 showed how difficult it can be for policymakers to control financial outcomes, even in a system where the government runs most of the banks and can exert outsized pressure on creditors, suppliers, and other counterparties. Contagion risk was full on display yesterday. Chinese junk bond yields jumped to an 18-month high, and shares of real estate companies plunged after Evergrande had its credit rating downgraded and requested a trading halt in those onshore bonds. Some banks in China appear to be hoarding yuan at the highest cost in almost 4 years, a sign that they may be preparing for what Mizuho Financial Group strategists called a liquidity squeeze in crisis mode. Where Xi will ultimately draw the line remains a mystery. While China's top financial regulator has urged billionaire Evergrande founder Hu Kaiyan to solve his company's debt problems, authorities have yet to spell out whether the government would allow a major debt restructuring or bankruptcy. Even senior officials at state-owned banks say privately that they're still waiting for guidance on the long-term solution from top leaders in Beijing. Evergrande's main banks were told by China's housing ministry this week that the developer won't be able to make interest payments due on September the 20th. And China's government isn't adverse to taking over companies from the private sector if needed. It seized Bosheng Bank back in 2019 and assumed control of H&A Group, the once sprawling conglomerate, in early 2020 after the coronavirus pandemic decimated the company's main travel business. Court-led restructurings have also become more common in recent years, with more than 700 being completed in 2020. The Evergrande endgame may depend largely on how Xi decides to balance his goals of maintaining social and financial stability against his multi-year campaign to reduce moral hazard. The timing is particularly tricky as China juggles an economic slowdown, a sweeping crackdown on the private sector, and rising tensions with Washington, all in the run-up to a once-in-a-5-year leadership reshuffle in 2022, at which Xi is set to extend his indefinite rule. The government has to be very, very careful in balancing support for Evergrande, said Yu Long, a former China Bank and Insurance Regulatory Commission regulator, and now Chief Risk Officer at China Agriculture Reinsurance Fund. Property is the biggest bubble that everyone has been talking about in China, Yu told Everbright Song Hung Kai analyst Jonas Short in a recent podcast. So if anything happens, this could clearly cause systemic risk to the whole China economy. And meantime, a group of China Evergrande Group bondholders has selected investment bank Moelis & Co. and law firm Kirkland & Ellis as advisors on a potential restructuring of a tranche of the bonds. The advice focuses on around $20 billion in outstanding offshore bonds in the event of non-payment. Evergrande has been hit by recent ratings downgrades, with both S&P Global Ratings and Fitch Ratings warning of the risk of default, while a main Evergrande unit applied on Thursday to suspend trading of its onshore corporate bonds in a move indicating a rising likelihood of defaults and restructuring, market participants said. Fitch Ratings has estimated that it faces bond interest payments of around $129 million before the end of September and $850 million before the end of the year. Nevertheless, hopes of securing a restructuring helped boost Evergrande's bonds, which hit close to 30 cents on the dollar on Thursday, with the March 2022 issue rising the most, up 2.5 cents. The bonds are rallying pretty hard, said one holder. People are buying blocks, so it seems it's institutional demand rather than just retail. And more broadly, maintaining social order has always been paramount for the Communist Party, which has little tolerance of protests of any kind. In Guangzhou, home buyers surrounded a local housing bureau last week to demand Evergrande restart stalled construction. Disgruntled retail investors have gathered at the company's Shenzhen headquarters for at least 3 straight days this week, and there are unconfirmed videos of protests against the developers in other parts of China, which have been widely shared online. Evergrande has 1.3 trillion yuan, or $202 billion, in pre-sales liabilities at the end of June. That's equivalent to about 1.4 million individual properties that it has committed to complete, according to a recent report. If Evergrande had to dump its inventory onto the market, it would drag down property prices substantially, said Ho Hong, chief strategist at BOCOM International. Without a social safety net and with limited places to put their money, Chinese savers have for years been encouraged to buy homes whose prices were only ever supposed to go up. Today, real estate accounts for about 40% of household assets, and buying a house or two is a cultural touchstone. While housing affordability has become a hot topic in the West, many Chinese are more likely to protest falling home prices than spiking ones. Given that the bulk of people's wealth is already in property, even a 10% correction would be a serious knock to many people, said Fraser Howie, an independent analyst and co-author of books on Chinese finance, who's been following the country's corporate sector for decades. It would certainly knock their hopes and dreams and expectations about what property is, he said. Another potential flashpoint is whether Evergrande can repay high-yield wealth management products that it sold to thousands of retail investors, including many of its own employees. About 40 billion yuan of those are expected to be repaid, according to Kaysen, a Chinese financial news service. Evergrande is trying to free up cash by selling assets, including stakes in electric car and property management businesses, but has so far made little progress. Evergrande is the largest high-yield dollar bond issuer in China, accounting for 16% of outstanding notes, according to Bank of America. Should the company collapse, that alone would push the default rate on the country's junk dollar bond market to 14% from 3%, they wrote in a note quite recently. And while Beijing has become more comfortable with allowing weaker businesses to fail. An uncontrolled spike in offshore funding costs would risk derailing a key source of financing. And it could also undermine global confidence in the country's issuer at a time when Beijing is pushing for larger foreign investor ownership. Yields on China's junk dollar bonds are nearing 14%, up from about 7.4% in February. The stakes are higher on the mainland, where the credit market is about 15 times the size at $12 trillion. While Evergrande is less of a whale onshore, a collapse would force banks to cut their holdings of corporate notes and even freeze money markets, the very plumbing of China's financial system. In such a credit crunch, the government or central bank would likely be forced to act. And banks involved in property lending may come under pressure, leading to an increase in soured loans. Smaller banks exposed to Evergrande or other weaker developers may face significant increases in non-performing loans in the event of a default, according to Fitch Ratings. And concerns over Evergrande comes at a time when China's economy is already slowing. Aggressive controls are there to curb the outbreaks of COVID-19, and that's hurting retail spending and travel, while measures to cool property prices are also taking a toll. Data this week showed home sales by value slumped 20% in August from a year earlier. That's the biggest drop since the onset of the coronavirus earlier last year. And responding to a question on Evergrande's potential impact on the economy, National Bureau of Statistics spokesman Fu Linghai said some large property enterprises are running into difficulties and the fallout remains to be seen. China's current priorities of promoting common prosperity and deterring excessive risk-taking means there's unlikely to be any easing of property curbs this year, according to Macquarie Group. The sector will be a main growth headwind for the next year, although policymakers may loosen restrictions to defend growth goals, they said. A correction in China's property market would not only slow the domestic economy, but have global consequences too. A significant slowdown in property construction over the next few years appears probable already and would become even more likely in the event of an Evergrande failure or bankruptcy, said Logan Wright, a Hong Kong-based director at research firm Rhodium Group. A long-term slowdown in property construction, an industry that represents about a fifth or a quarter of China's economy by the most estimates, would cause a significant decline in GDP growth, commodity demand, and would likely have disinflationary effects globally. Now, that may not necessarily sound dramatic, but it is when leverage comes into play that the real problem hits. China's real estate sector accounts for nearly 1/3 of the entire economy, while the banking sector is currently almost 3 times as large as GDP, which means banks are leveraged up to the brim with private debt. So you have a vulnerable system with tremendous private debt and banking leverage. Now, a company that was flagged by the Chinese central bank back in 2018 as posing systemic risk to the entire economy is about to default. It's easy to imagine a domino effect that ripples through markets as financial institutions that have been exposed to Evergrande suffer serious damage. Now, of course, Beijing won't just let that happen. The private sector might be drowning in debt, but the government has plenty of dry powder and cards to play. It could stop any domino effect at its root by bailing out the most fragile players. But when you combine the fragility in the Chinese system with signs that economic momentum is already crumbling and that the regulatory crusade that Beijing has embarked on is one risk too many, policymakers might be able to stop a default cascade, but they can't revive growth without making the nation's leverage problem even worse. This might be the most dangerous grey swan event for the global economy right now. The fallout has been contained to stock markets in Hong Kong and China so far, but if the situation deteriorates any further, the next levy to break might be China-sensitive currencies like the Australian and New Zealand dollars. So there's a lot to play out here, a lot of uncertainty, and it's probably too soon to make a call as to whether it's really going to trigger another Lehman or whether China will intervene sufficiently to stop it falling apart. My own suspicion is they might do something to support local bondholders, but I'm less convinced that they're going to be too worried if some of those international bonds default, and that might be a problem. Now, the Fed meets next week and is expected to take a potentially decisive step that flags likely changes to some of its crisis programs at an upcoming meeting. It's the type of moment that requires deft communication at the Fed chair's post-meeting press conference, now muddied, though, by likely queries about his colleagues' investing habits and the possible blow to public trust. Within days of news that two Federal Reserve Bank presidents had engaged in controversial stock trades, one of the fiercest critics of the US central bank's financial system oversight demanded new ethical rules that would bar such dealings in the future. For Fed Chair Jerome Powell, however, it's the wrong problem at the wrong time. Under consideration for reappointment as Fed Chair, while also juggling how to pull off a critical change in US monetary policy, Powell faces a controversy of the Fed's own making that helps reinforce arguments by progressives for broader change at the central bank. Powell remains favoured for renomination by President Joe Biden, and if history is a guide, his decision may come in the weeks between the Fed's policy meeting next week and its two-day session on November the 2nd, 3rd. That would match a point in the calendar when the last two Fed chair appointments were announced. But Democratic Senator Elizabeth Warren on Wednesday wrote to the Fed's 12 regional presidents asking them to impose strong and enforceable ethics and financial conflicts of interest rules and to send her an action plan no later than by October the 15th. That's at a minimum a distraction to Powell at a time when he's steering the Fed through complex debate over monetary policy. Institutionally, it's a bad look, said Tim Dwyer, chief US economist at SGH Macro Advisors and an economics professor at the University of Oregon. It's better to get ahead of this. Powell has moved to do so, launching a broad review of the Fed's rules governing investments by senior officials. But unless change comes quickly, Warren's direct demands set up a possible clash with a key Democratic lawmaker when Biden's eventual Fed pick goes for Senate confirmation. Warren, a member of the Senate Banking Committee, which will provide the initial vetting of the nominee, voted against Powell as Fed chair 4 years ago and has criticised the Fed's approach to financial regulation on his watch and has yet to state an opinion about his possible renomination. She credited the move by Dallas Fed President Robert Kaplan and Boston Fed President Eric Rosengren to sell the investments in question, but said a decision made amidst an ethic firestorm left no guarantee that Fed officials are acting solely in the public interest, not based on their own financial interests. The security trades last year by Kaplan and Rosengren during a pandemic year when tens of millions faced unemployment were judged to have complied with the Fed's code of conduct. The Fed's 12 regional banks are part of the Federal Reserve System but operate as quasi-private entities with their own boards of directors, many drawn from the banking industry. And the presidents of those institutions share 5 rotating votes on monetary policy alongside up to 7 members of the Fed's Washington-based presidentially appointed Board of Governors. Regardless of its impact on Powell's possible nomination, the controversy is a blow to a pair of issues the Fed chair has put at the centre of his tenure: building public trust that the Fed is managing the economy for the country as a whole, not just its investing class, and building support for the Fed's independence amongst congressional lawmakers critical of the central bank's enlarged footprint in the economy since the last crisis. And he's arguably made some headway on both. He's held more one-on-one meetings with lawmakers than his immediate predecessors, Janet Yellen and Ben Bernanke, and in recent days he's picked up renomination endorsements from senators of both parties. A revamp of monetary policy last year put new emphasis on job growth and led many supporters of Biden, including progressive Labour-focused economists, to argue that Powell had earned a second 4-year term when his current one expires in February. Yet, among those opposed to him, one of the chief complaints is his perceived closeness with Wall Street and a willingness to take a lighter touch toward the regulation of banks and now perhaps towards the regulation of other central bankers. Powell still hasn't acted. He has not yet actually cut off the flow of insider information to Rosengren and Kaplan, said Jeff Hauser, founder of the Progressive Revolving Door Project, which opposes Powell's renomination in favour of Federal Governor Laurel Brainard. The immediate and necessary, even if insufficient, step will be to place them on administrative leave, he said. This will just harden the degree of distrust among people who think about financial regulation, insider trading, and ethics law. And that really is the point, that there is a moral standard here which is indisputable. Central bankers are tending to protect particular sections of the economy, particularly the financial markets and the financial sector, rather than the whole economy. And we're seeing that in multiple places around the world, and this is yet another example. In Australia, the collapse in the price of iron ore has dragged the Australian share market down slightly for the week, offsetting gains from several blue chip stocks. The S&P ASX 200 index fell 2.9 points, or 0.04%, to 7,403 over the week, with Friday's 56.5 point, or 0.8%, loss weighing heavily after a strong start to the week. An 18% fall in the price of iron ore hit the major miners this week, with BHP Group, Rio Tinto and Fortescue Metals leading losses for the local market. BHP dipped 5.1% to 39.16, Rio slid 7% to 98.80, and Fortescue dropped 16.4% to 15.27. The smaller iron ore miners were also caught up in the sell-off, with Mineral Resources down 9.2% to 48.26 and Champion Iron down 6.6% to 5.11. Irish shares dropped 12% to 12.08 as Swedish private equity group EQT walked away from a takeover bid for the financial services software company. EQT had been granted access to the company's books, but said it had not been able to sufficiently confirm its investment hypothesis through its due diligence process. And Brambles slid 9.3% to 11.18 after it flagged a heavy step-up in capital spending to digitise and modernise its operations. The company said the programme would cause a temporary slowdown in profit growth this year. AMP closed below $1 for the first time in its history on Friday. The shares ended the week 6.2% down at 99 cents. But those declines were offset slightly by a stronger performance from several blue chip stocks. CSL was up 2.2% to 309.36. CBA added 1.8% to 102.88. Macquarie Group firmed 3.4% to 180.17. And Scentre Group climbed 5.7% to 299. The energy sector supported those gains, with oil and LNG prices both on the rise. Woodside Petroleum climbed 9.5% to 21.11. Santos advanced 4.5% to 6.33. Oil Search rose 2.9% to 3.84. And Beach Energy closed the week 2.9% up at 1.06. Pilbara Minerals soared 11.7% to 229 after it reported strong participation and bidding in its second lithium concentrate digital auction held through its battery materials exchange on Tuesday afternoon. Qantas shares climbed 3.9% to 5.53 after the airline scheduled its first international flights for the mid-December restart that it flagged at its annual results day last month. Tech stocks also rallied this week, with Altium up 14.4% to 36.28, Wise Tech Global up 7.8% to 52.78, Xero up 2.1% to 153.34, and Afterpay up 1.5% to 128.38. So locally, iron ore is going to be the story, I think, for the next few weeks. But internationally, you've got to look at the property sector in China. Evergrande looks to me to be the canary in the coal mine at the moment. Will the Chinese authorities bail or not? That will become the question. And if they don't, what is the fallout? We will watch and wait. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.